Hims and Hers just got destroyed, down nearly 40% in 6 months, and Wall Street is convinced it's over. The story is broken, the growth is done. But I'm looking at the actual numbers and I'm seeing something completely different. Hey everyone, Vikram here, and I need to tell you why this matters. Because what's happening with Hims and Hers right now is a masterclass in how markets overreact to headline risk while completely missing the underlying business fundamentals. This is not about weight loss drugs anymore, and that's the entire point that nobody's paying attention to. Most investors looked at one news story, Novo Nordisk cutting Hims out of a partnership, and concluded the entire business was finished. That's it, game over, move on. But that's not how you analyze businesses, that's how you panic sell. Today, we're going to separate what's actually changed in the business from what the market is currently afraid of, because there's a massive difference between the two. Let's start with what happened. The main driver behind the sell off is Hims and Hers relationship with Novo Nordisk, or more accurately, the lack of one. In early January, reports confirmed that Hims and Hers was once again excluded from Novo Nordisk's US partner list for its newly approved weight loss pill. Instead, Novo chose to distribute through companies like CVS, Costco, Amazon Health, LifeMD, and GoodRx. That decision matters. And I want to explain why weight loss treatments have been one of the fastest growing revenue contributors for digital health platforms. Hyams and Hers had been selling compounded semaglutide, the same active ingredient used in Novo's injectable drugs, at a much lower price point. While legal under compounding rules, these products directly competed with Novo's branded offerings, which led to legal disputes and a clearly hostile relationship between the two companies. With Novo now launching a pill version of its treatment, the balance of power shifted. Pills are easier to ship, easier to prescribe, far more appealing to mainstream consumers than injections. That's why Wall Street revised down expectations for Hims and Hers future free cash flow, especially in the next 2 to 3 years. But here's where most investors make a critical mistake. Lower expectations do not mean low growth. Even after analyst downgrades, consensus projections still show Hims and Hers generating nearly $300 million in free cash flow by 2026 and 2027. That represents triple digit growth compared to current levels. The company is still expanding rapidly, just from a lower peak than previously assumed. And this is the key distinction that separates quality investors from panic traders. The business fundamentals have not changed. What changed is the size of the opportunity, and the market is treating that like the company is dying. It's not. At the same time, Hims and Hers continues to execute on its broader strategy, and this is what nobody's talking about. The company is becoming a vertically integrated digital healthcare platform, not just a weight loss drug distributor. A key recent development is the launch of the lab, a biomarker testing service offering comprehensive blood analysis directly integrated into the Hyams and Hers app. This allows users to receive personalized insights and treatment recommendations without navigating traditional healthcare systems. Think about what that means. Healthcare remains one of the most inefficient and frustrating industries for consumers. Long wait times, opaque pricing, poor user experience. Customers are actively looking for alternatives. Hyams and Hers is capitalizing on that dissatisfaction by offering convenience, transparency, and accessibility. That's the future of healthcare, not Novo's distribution model. Digital platforms integrated into people's phones. Let me give you the revenue trajectory, because numbers don't lie. Revenue has grown from roughly $100 million in 2020 to an estimated 2.3 billion in 2025, with projections reaching over 3 billion by 2027. That's from 100 million to 3 billion in 7 years. That's explosive growth. That's a real business that's scaling. And here's what separates Hims from every other hyper growth stock. Flow margins have improved dramatically over the past few years. They've turned positive. They've expanded to double digit levels. That combination, rapid revenue growth and improving profitability, is rare in consumer healthcare. Most companies trading growth for losses forever. IAMS is doing both, growing revenue while printing cash. Now let's talk about valuation, because this is where the opportunity comes in. Updated intrinsic value estimates have declined due to lower expectations around weight loss drug sales. At current prices, the stock appears roughly fairly valued based on conservative assumptions. On a forward earnings basis, IMS trades at a premium multiple, but that multiple is consistent with its historical range. Given the company's growth profile, the market is not giving it a free pass, it's pricing it appropriately for what it is: a high growth, improving profitability digital healthcare platform operating in an industry that desperately needs disruption. But here's what creates real upside from here. Optionality. Hims and Hers has millions of active customers. That customer base is extremely valuable to pharmaceutical companies, including Novo Nordisk. If partnerships evolve, if regulations shift, if alternative treatments emerge, revenue assumptions could move meaningfully higher again. The compounded semaglutide business was a temporary advantage, but the platform itself, the customer relationships, the operational infrastructure, the app integration, the brand trust, those are all permanent and they're worth billions. At the same time, downside risks are real: losing access to compounded treatments, regulatory pressure, slower consumer adoption. These could weigh on margins and growth. So let me be clear, this stock is not a low risk investment, but at current prices, the market is already pricing in many of those concerns. For investors willing to tolerate volatility, Himes and Hers represents a platform business operating in an industry ripe for disruption with a proven ability to scale revenue while improving profitability. That's the opposite of most hyper growth companies. Most are burning cash, HMS is generating it. Here's what I'm watching for. First, whether the company can maintain its customer acquisition economics without relying heavily on weight loss drug marketing. That's the fundamental test. Second, whether the lab and other ancillary services can become meaningful revenue contributors. That's the diversification test. Third, whether partnerships with other pharmaceutical companies can offset the Novo relationship loss. That's the optionality test. If all three happen, you're looking at a company that's scaled past the Novo controversy and proven that the digital healthcare platform thesis is real. Let me give you my take. The market saw one headline and decided the story was over, but the actual story is just beginning. Hims and Hers is building something bigger than weight loss drugs. It's building a healthcare platform for the digital generation. That's why the stock got crushed. Not because the business is broken, but because investors were betting on a temporary tailwind, and when that tailwind faded, they panicked. For investors who understand what the company is actually building, the 40% decline is not a signal to sell, it's a signal to pay attention. This is the kind of dislocation that creates real opportunity for patient investors, not because the stock will moon, but because the business is fundamentally sound and the market is currently terrified. And that's when you find real value, when fear disconnects from reality. Thanks for watching. Vikram here. See you in the next one.